Hello, everyone. Good to see you. Good morning. I'm Tom Zuber. I'm the managing partner of Zuber Lawler. We're a law firm that's been in cannabis since 2006. We're headquartered in Los Angeles, where I live, but we have offices across the country and represent many of the larger players in the space in relation to deals and IP and regulatory work, litigation, investigations, and expansion, and so forth. We have an outstanding group of panelists here and a great topic. The topic here today is growth capital in 2024. What makes a company investable in cannabis these days? That's an excellent question, and I think we have a stellar group here to talk about it. So first, going from left to right, or your right to left, I should say, we'll go ahead and allow the panelists to introduce themselves briefly, and then we'll just dive into it. So at the end there, John Darwin. John, you want to say a few words about yourself and Luminous?
Sure. I'm John Darwin, managing partner of Luminous Capital. We're a New York-based private investment company focused solely on cannabis, and been around since 2019, and I've made a few investments in the space, both equity and debt, and really primarily focused on the U.S.
Maris?
I'm Maris Scott. I'm actually from Boca Raton, Florida. Right now, I'm the CEO of Shiny Health and Wellness Corp. We have 42 dispensaries in the Ontario area of Canada, and we're looking to expand outside the country.
Morgan?
Morgan Paxia, co-founder of Poseidon, been investing in the industry for over a decade. Just want to give a good shout out to Benzinga for another kick-ass event. You guys are rocking it. Love what you're doing.
Hi, Brett Finkelstein. I'm managing director of SkyVest Partners. Before that, we started investing in cannabis in a fund that I co-founded in 2014 called Fido Partners. Through the vehicle and a second fund we launched in 2018, we made about 30 investments in the ancillary ecosystem of today's cannabis economy.
Thank you, Brett. Why don't we go back to John here for the first question, and let's start with a big open question here that I think is appropriate. Does it still make sense to invest in cannabis? And if so, where does an investor go to find good investments in such a chaotic environment?
Well, first, and why we're all here, yes, it still does make sense to invest in cannabis. We are actively investing in cannabis, and we'll continue to do so. I think it's certainly been a challenging, we'll call it 18 months, but in particular the last 12 months for operators. And what operators might not see as much is challenging on the private equity, on the capital side of fundraising, of being able to manage existing portfolios versus new ones. So though it's been challenging, what we're really starting to see now, I think, is efficiency in operators. The people that are going to succeed in the long run are starting to truly define themselves, and folks that might have been a hey, let's talk later 2 years ago are becoming serious conversations for investments now, and those relationships are turning into deals that are happening.
Brett, what are your thoughts on that?
I agree. I think it's always a good time to invest in any asset class where we're all sitting in a market that's pretty nascent, even though it's been around a long time in certain states. I think just got to pick where you're going to deploy capital. There are public companies, there's private companies. At least now in 2024, we have data and an analog of companies' performance. And if you do want to invest in the asset classes of the whole, cannabis, there are vehicles to do that, debt, equity, and again, there's companies out there and individuals and great management teams that need growth capital or need any kind of capital, and fueled with human capital as well, that I think that most of us up here really do as well, is to fuel the capital with human capital and help amplify stories of companies that we've invested in.
Great. So the rumors are true. Companies are still getting capital in the cannabis industry. I can confirm that because deals are still happening. They are fewer and further between, but there are still exciting financing and equity deals happening. Let's go ahead and speak now also to the entrepreneurial perspective. I know Benzinga does such a great job of bringing the capital to to the company entrepreneurs. So why don't we direct this next one to you, Maris. What are the common mistakes or pitfalls that cannabis entrepreneurs should avoid when seeking investment in this environment?
You know, I look at it from a different perspective. I think the first thing you have to look at is basically if the company you're investing in is new, and if the company you're investing in has already made some mistakes. I think one of the major reasons I invest in cannabis companies is companies that are going through turnarounds, that have already corrected some of their miscues, and have already cut their corporate overhead and cut some of their expenses and know the direction that they're going in.
Great. Morgan, what are your thoughts on that topic? The notion of mistakes that entrepreneurs might avoid when seeking investment.
Yeah, so it's interesting, entrepreneurs, this kind of falls into a little bit of like the M&A environment too. I'd say a common mistake we see is a misunderstanding of the value proposition, what the company's worth, what the company's probably worth at an exit. You know, if you're trying to attract venture capital, we're in the business of making money just as you are, and so price matters. And I think there's just this idea that, you know, cannabis has so much potential, so these companies should be highly valued. And I think after a decade of seeing that could be true in some instances, overall, we just need to be very sensible about how that happens. If we want to see capital continue to come in, that means we need to see, you know, good investments being made, entrepreneurs being realistic about the valuations, building good companies, and not being afraid to hit the bid, you know, to sell the company and do another great company. Because I can tell you, if you build a great company and sell it, those investors will likely back you again. And so not trying to always be the next unicorn is okay. It's actually great. And I think that's something that we need to talk about a lot more.
Yeah, I think those are great points, Maris and Morgan. I can confirm the same thing. As an attorney in the space, selling the dream is kind of over, and what you're selling are numbers. And I think if you focus on selling numbers, you're going to have a lot more success in this environment. Are there particular types of opportunities? For instance, types of companies, dispensaries versus cultivators versus processors, or types or geographies, certain states or territories of the world that present better investment opportunities in this cannabis environment than in others. And Morgan, why don't we stick with you on that one?
Sure. I think I kind of heard it's a little hard for being a deaf guy, but just about where we like to, or where we see opportunity.
The types of opportunities. So in other words, the categories of opportunities.
Yeah.
So for instance, some folks are looking only for dispensaries, right? And also the geography. So folks will often stay away from California, which definitely hurts my feelings. But they are focused, for instance, on, say, Ohio or Missouri. Yeah.
Cool. Okay. Yes, we are generally bullish on access. That's kind of a simple way of saying retail. Penetration in new markets. You know, Ohio is definitely a very interesting market. Super excited for them that they're actually getting that market open sooner than we all thought. I think, you know, we're also focused on being here in Florida, which is also very cool what's happening here. But Ohio is, you know, they're getting their adult use market open sooner than we all thought. And that's really great. It's going to be a really good market. They're going to see a nice inflection in growth. So that's a market we like, seeing access. But, you know, retail is so important about where the doors are located can be such a big difference in the driver of people coming in the door. And that's how you really drive the value. We're not actually opposed to California. We wish California could get its act together. They just can't seem to get out of their own way. But there's so many weed deserts, meaning towns that are not opting in. And so you have this rampant illicit market. You know, we could talk about it for days, but if they would have limited door opportunities in those markets, they would be very interesting opportunities to invest in. We just haven't seen that movement. But otherwise, it's like New Jersey's doing a great job, Pennsylvania. We'd love if Massachusetts would lift its cap from a three-store cap to maybe 6 or 10. I think that would create a lot of M&A opportunity and some good doors to be consolidated there. But we like that. We feel like capacity is so easy to overdo, right? And you've seen this time and time again. Wholesale prices start at, you know, 5,000 or whatever, and they get competed all the way down to 1,000. Or, you know, that's a really painful cycle to go through. Again, as venture investors, you want to make sure that we're being cognizant of that return profile. So we like access. That's kind of been a big focus for us.
Great. Thanks, Morgan. Let's talk about Florida a bit. Florida is very exciting now. It's looking to go recreational. Brett, what are some of the opportunities here for companies both in-state within Florida, in the context of Florida contemplating recreational movement here, and also for MSOs out of state looking to enter Florida?
Yeah, I'm a Florida resident. I've been here 20 years. The market right now has mostly MSOs. It's a vertical market, so you have to grow, process, sell, deliver. It's a robust market. It's over 600 stores, 800 plus thousand patients. Recreational market, I think for an MSO that if you're not in the Florida market, you're going to have to be here. It's one of the states that is on hyper growth on both visitors but also residents coming into the market. The people that are here now with the 600 plus stores probably have an easier time switching that to ground game. Possibly we'll see that happen in the next election in November. It's going up. It's passed. They have the signatures, but the market here, you're from California. We've all seen what happened there. I do believe that this market is ripe for this recreational market. And as Morgan said before, it's the investing states that he's looking in, the access. We like, and I think everyone does see, that Florida has the access and has the community and has everything else, but it started as a medical market that had a moat around it first and didn't let unlimited market share come and flood the market. So I think now when that happens, we'll still see the access being great, but the stores here, I think, will be unbelievable market for Florida.
Great. Maris, you're obviously Shiny Health and Wellness is based in Toronto, but you're a fellow resident of Brett's here in Florida. I'd love to get your thoughts as well for the sake of our audience.
I've had this conversation before. I've lived in Florida a little longer than you, probably 25 years. And I've seen the entry into the Florida market MSOs came in and there's only a few brands. And then I've seen some brands leave. And I think that a Canadian brand still has to make a footprint here. I think some of the dispensary,
I'm having some work done up there.
I have people cheering for me from Canada
Banging
up there.
on the door, trying to get it.
That's it. They're trying to get in. The bottom line is, I think that Canadian brand does have to put a footprint here, whether it's a dispensary brand, whether it's a collaboration with an MSO, because this whole area of South Florida, before you get to Miami, was where I grew up. I mean, we have a huge Ontario basis here, Toronto, Montreal, and all these apartments are full of Canadians. So I think there has to be a collaboration somewhere here in this area with dispensaries from Canada.
That's a great point. John, let's give our friends here in the audience some practical advice here. What are the key indicators or metrics that you look for, that Luminous looks for, when considering investment opportunities in the current environment?
That's a great question, and one that I think certainly evolved, and it's evolved as the industry's evolved for us. We saw a big influx of debt capital a couple years ago that now has forced our investment process to prioritize looking at the cap stack almost first and foremost. There's so many different lenders that have different covenants, different debt burdens, and that's become an increasingly important metric that I think really wasn't as vital. It's always important to look at the cap stack, but with all of the senior secured lenders, the mortgage REITs, the lease liabilities, that's something we look at. We spend a lot of time on the balance sheet of the companies. I think a big conversation right now is, of course, around rescheduling. It's around 280E. It's around taxes payable and what's your actual plan. And I think there's a level of aggressive tax planning versus more conservative, where we're probably somewhere in the middle on the more conservative side that we like. But I've also been an operator, understand what it's like paying 60-70% taxes, and try and figure out a way to mitigate that risk. Company-wise, we're seeing a few different things. I think important to note that now we're hearing a lot of there's distressed assets. We have an M&A strategy. I want to acquire these dispensaries, and that's great. I think I've been pitched a roll-up in cannabis 1,000 times just this year. So the people that can do it and have shown that they can do it will believe in that strategy. I think to Brett's point, and Morgan, we've talked around this actually just about 30 minutes ago. understanding the value add, the valuation of those deals is a very nuanced game. So M&A strategies are difficult for us to get behind without the right operators. And then of course the stuff that I think any investor would say, what do your margins look like? How are you growing revenue? Are you generating additional organic growth from these same stores, and EBITDA positive, breaking into free cash flow, all those things. But I think the cap stack and organic growth has become more important for us as initial criteria.
How rare is that metric found? In other words, are you seeing much organic growth out there these days?
I think we are. Statewide, in a lot of the states that we look at, we're seeing consumers feel the impact of inflation. We're seeing broader markets have issues, but the stores that have tweaked their marketing plan, maybe they're not investing in billboards because they don't work. Maybe they figured out how to fine-tune the customer loyalty program. Those things excite us. So we are seeing customers that are companies that are figuring it out and being able to grow same stores in difficult markets, like California, for instance.
Thank you, John. Morgan, let's talk about M&A. Obviously, we can't talk about investment in cannabis without talking about M&A. And I'd like to discuss just in a broad sense, with an open question, what's the impact of mergers and acquisitions on the cannabis investment landscape today?
Sorry, the bang is okay. So M&A, I think I understood. What I would say is where we're seeing most success in M&A is on the operator side. You're seeing deals get done. Shout out to Nancy with Wana. That was a fantastic deal. But think about in the last year, Sunburn's doing a great job here in Florida, but then you look at TerraSend, Ascend, they're getting good deals done, expanding into new states, reasonable size deals, right? These are not massive deals. I think the tech side of our industry has not been as good at that. I think partly because there still is this struggle of the bid ask is so wide of what people again think their technology company might be worth versus what it really is, and so it's harder to get those deals done. And I think that's probably because there's less comparables for people to look at, right? With the public companies, we have a whole slew of companies to look at, and we can see valuation metrics around, EV to sales, EV to EBITDA, whatever you want to look at is some good metrics, and you can drill into certain states even. So there's a lot of more data around the operating side, and I think that's why it's probably been a little bit more successful, but we're still coming off of a super low cycle. And I think, again, if we're being reasonable, we can see more deals getting done, and as things start to get better again, you'll see the deal values increase. But for now, it's we're still just coming off of such a tight capital cycle, and we got to get the money moving again in the space. Got to get it recycling so that investors can be reallocating or whatever it might be. But we just, So I think from an M&A perspective, there's so much to go. But there's so much that goes into the thought, is it what's the operational efficiency, what's the cultural efficiencies or cultural alignment, and once you get through all that, then you're starting to talk about price. It's not easy, it's definitely a lot of value can be destroyed in bad deal making, and so but when it works great, it's super accretive, and that's what we want to see more of, obviously.
Great. Ann, am I getting the hook? Okay. Do I have time for one more? Okay, well, with that directive, I'm going to go ahead and say thank you to our outstanding panelists here. It's great to see everybody on it. And thanks to all of you. Really appreciate the time. Thank you. And thank you, Benzinga. Thank you, Ann.